Most retirees believe Social Security is untouchable, but up to 85% of your benefit can become taxable income. And the threshold deciding this has not moved since 1993, which means ordinary decisions you make this year could be quietly pushing you across a line you never knew existed. Here's the part almost nobody understands correctly. 85% taxable does not mean the IRS takes 85% of your check. It means up to 85 cents of every Social Security dollar gets added on top of your other income and then taxed at your normal rate, whatever that happens to be. So if your tax bracket is 12%, you are not losing 85% of your benefit. You are paying 12% tax on 85% of it. That distinction matters because the headline number sounds terrifying, but the actual dollar impact depends entirely on what else is happening on your return. So, how does the IRS decide which tier you fall into? They use something called combined income, and this is the number that controls everything. It is not based on your age, it is not based on how long you have been collecting benefits, and it has nothing to do with whether you consider yourself wealthy or not. It is purely a math formula, and the same formula applies whether you are 70 or 90 years old. Combined income is your adjusted gross income, not counting Social Security, plus any tax exempt interest you earned, plus half of your Social Security benefit for the year. Add those three things together, and that single number determines whether none, up to 50%, or up to 85% of your benefits get taxed. Notice that this formula uses half of your Social Security benefit just to figure out whether the other half gets taxed, which is exactly the kind of circular calculation that makes people give up and just let their tax software handle it without ever understanding what is actually happening underneath. For a single filer, if that combined income number is under $25,000, none of your Social Security is taxable. Between 25,000 and 34,000, up to 50% becomes taxable. Above 34,000, up to 85% becomes taxable. For married couples filing jointly, those same tiers sit at 32,000 and 44,000. As a quick example, a single retiree with $18,000 in Social Security, $22,000 in other income, and $2,000 in interest would have a combined income of $32,000, which lands them inside the 50% tier, meaning up to $9,000 of their benefit could be added to their taxable income for the year. And here is the detail that catches people completely off guard. These numbers have never been adjusted for inflation since they were written into law over 30 years ago. Your benefit gets a cost of living increase almost every year. The threshold that decides whether that benefit gets taxed does not move at all. So picture two retirees with the exact same lifestyle 10 years apart. The one retiring today has a higher Social Security check thanks to years of cost of living adjustments, but is measured against the same $25,000 line that existed when gas was under $2 a gallon. Every COLA increase nudges more retirees over a line that was never designed to move. If you are finding this useful, go ahead and subscribe now, because in a minute we are going to walk through the 5 most common things retirees do that quietly drag them across these thresholds without realizing it, and one of them might already be happening to you right now. The first trigger is taking a regular IRA or 401k withdrawal without checking the math first. Every dollar you pull from a traditional retirement account counts as ordinary income, which goes directly into your combined income number. If you are sitting close to that 25,000 or 32,000 line, a withdrawal that seems small on its own can be the exact amount that pushes 50% of your Social Security into taxable territory for the entire year. And because the formula only counts half of your Social Security benefit going in, a withdrawal that looks modest on paper can have an outsized effect once it interacts with that half-counted benefit and crosses the line. The second trigger is tax-exempt municipal bond interest. Most people assume tax-exempt means it has no effect on their return at all, and in terms of regular income tax, that is mostly true. But for this specific calculation, tax-exempt interest gets added back in. So a retiree who moved money into municipal bonds specifically to reduce their taxable income may have unknowingly increased the portion of their Social Security that becomes taxable, which can partially or fully cancel out the benefit they thought they were getting. It is one of the few places in the entire tax code where something labeled tax exempt still has a direct, measurable effect on how much tax you end up owing. The third trigger is part time work. A lot of retirees pick up part time income assuming it is separate from their Social Security situation entirely. But wages count fully toward combined income, and even a modest part time job can be the difference between 0% of your benefits being taxed and 50% of them being taxed, especially for a single filer close to that $25,000 line. Someone might take a part time job specifically because they feel they need a little extra cushion, only to discover that the cushion came with a hidden cost attached to it in the form of newly taxable Social Security income. The fourth trigger, and this is the one that surprises people the most, is filing as married filing separately while still living with your spouse. Under this filing status, the IRS assumes 85% of your Social Security is taxable regardless of your income level. There is no 0% tier and no 50% tier. If a married couple chooses this filing status for any reason while living together, Social Security taxation effectively gets locked at the highest tier from $1. This is one of the costliest filing status decisions a retired couple can make without realizing it, since most people choose married filing separately for reasons that have nothing to do with Social Security at all, like keeping medical expenses or student loan payments separate, never imagining it would affect their benefits this way. The fifth trigger is a large one time event, like a Roth conversion, selling an investment property, or taking a lump sum from an old pension. These are not recurring income, but the IRS does not care whether income is recurring. It only looks at your combined income for that specific year. A retiree could go from paying zero tax on their Social Security one year to having 85% taxable the very next year simply because of a single transaction, and then go right back to 0% the year after that. If you know a large transaction like this is coming, the smart move is to plan for it the year before, not discover it after the fact when your accountant hands you the bill. So here's the real takeaway: these thresholds are not going anywhere, and they are not adjusted for the cost of living the way your benefit is. That means more retirees cross into the 50% and 85% tiers every single year, often without changing their lifestyle at all, simply because their benefit went up while the threshold stayed exactly the same. The only real defense is knowing where your combined income sits relative to these numbers before you make a withdrawal, take a part time job, or do a Roth conversion, not after you have already filed and seen the result on your return. If you have ever opened your tax return and been surprised to see Social Security listed as taxable income, drop a comment with your age and whether you think one of these 5 triggers might be why. And if this helped make sense of something confusing, subscribe so you do not miss the next one, because these thresholds affect almost every retiree eventually, whether they realize it or not.